Welcome to WCrypto.
Hello, my friends. Welcome back to WCrypto.
Guys, what a roller coaster ride today. In today's video, we're diving into a detailed Bitcoin technical analysis. And if you're into spotting market moves before they happen, you're going to want to pay attention to this one. We're breaking down the action with volume delta, retail versus whale positions, and what the funding rate tells us about the current trend. Let's get into it. So first things first, let's take a quick look at Bitcoin's price action. As you can see from the chart, Bitcoin has had some impressive moves recently, pushing above key levels like $93,000 and making a solid run toward $94,000. But what's really interesting here isn't just the price, it's what's going on behind the scenes with market participants, especially when we zoom in on volume delta. Now this chart shows us the volume delta on different time frames, and we're seeing something interesting. Retail traders, or those with smaller wallets, are going heavily long. Look at those green bars. Each one represents a surge in long positions being opened by smaller accounts. This typically signals confidence in a continued upward move. However, here's the twist. Whales, or large institutional players, are doing the opposite. The volume delta shows them taking on short positions. This could indicate a potential price manipulation strategy where whales are looking to set up for a liquidation of those retail longs. Let's talk about why that matters. When retail traders flood into the market and leverage their positions, it sets up an opportunity for whales to liquidate them at higher levels. This creates a classic whale trap, where smaller traders get caught in the wrong direction. Moving to the second chart, we see that retail longs are continuing to rise. This is reflected in the open interest increasing as well, suggesting more traders are betting on higher prices. But here's where things get a bit trickier. As more retail traders take long positions, the delta, or difference between long and short positions, is actually dropping. This drop in delta suggests that while retail longs are increasing, they aren't necessarily in control of the market. The key takeaway here is that while retail traders are optimistic, the market might not be as bullish as it seems. The delta drop often signals a weakening in market strength, meaning the buyers might be running out of steam. On top of that, the funding rates are crucial to understand here. Funding rates are still relatively neutral right now, but when there's an imbalance in positions like this, with retail flooding into longs and whales positioning short, the funding rate can shift dramatically. A higher funding rate would indicate that retail is overly confident in their long positions, further setting them up for a squeeze if the market moves against them. Now let's take a deeper look at the true retail versus whale dynamic. The chart shows the difference in positions between whales and retail traders, and we see something pretty telling. Retail longs are climbing steadily, but whales have been positioning more heavily on the short side. This disparity can often lead to sharp market corrections when the price doesn't continue upward as retail expects. When you look at the whale versus retail delta at the bottom, it shows us that whales are significantly outnumbering retail traders in terms of short positions. This suggests that whales are confident in a potential downturn and are positioning for a larger move down. Their short positions are being funded by the retail traders who are piling into longs. What's happening here is a classic case of whales trying to manipulate the market by building their short positions while retail traders are blindly chasing the price up. This often results in a situation where the price pushes higher, only to then reverse sharply, liquidating the long positions of retail traders and allowing whales to profit. Looking at the open interest chart, we can see the rising number of contracts being opened. Open interest is the total number of outstanding contracts that haven't been settled yet, and an increase suggests that more traders are entering the market. But pay attention here. An increase in open interest during a bull run typically signals that the market is getting crowded, which can be a warning sign of a potential reversal. As for the funding rates, notice how they've been fluctuating with market sentiment. The funding rate helps us understand the cost of holding a leveraged position. If the funding rate is too high, it means that longs are overly crowded and the market may be ripe for a correction. So with retail pushing their longs and whales on the shorts, we might see a sudden shift if the funding rate spikes, causing a cascade of liquidations. This could lead to a sharp downside move, especially considering the current whale dominance in short positions. So what should we take away from all of this? Right now, the market is in a kind of delicate balance. Retail traders are betting on more upside, but whales are positioning for a potential reversal. The funding rates are neutral for now, but they can shift quickly, and once they do, the price action could turn sharply against the retail crowd. If you're trading Bitcoin right now, you need to be cautious. With retail traders loading up on longs, the risk of a liquidation squeeze is high. Keep an eye on the delta and the funding rates. These are going to be your key indicators for understanding the direction of the market. If you see the funding rates go up and the whales continue to short, it could be a sign that the market is preparing for a reversal. Now let me walk you through my recent trade. It's a real-life example of how I apply my long wave strategy. Today I entered a long position at $92,613, which was based on the signals I was seeing on the 15-minute chart. My entry point was perfect for the conditions we saw earlier today, and I decided to exit part of my position during the day. I sold 50% of my position at $93,339, locking in a nice gain. The remaining 50% I exited at $93,164. Overall, my strategy entered at $92,057, and I sold at $93,135, securing a solid 1.06% gain in a relatively short amount of time. As you can see from the charts, my exits were slightly different. I ended up with a 1.04% gain on my first exit at $93,339 and 0.6% on my second exit at $93,164. The reason for this slight difference was the market volatility today, which caused me to get stopped out with my take profits. Bitcoin was moving fast, and the price hit some wild swings. If you look closely, you'll see that after my first take profit, the price surged almost 2% to $94,900 before pulling back. It even dropped below $93,200 for a while. This was a perfect example of how the market can be unpredictable, and a lot of traders got stopped out along the way, missing the ride to $95,000. I got stopped out too, but that's part of the game. Despite the volatility, the market is still aiming for $95,000, and I'm expecting another dip soon. This could be the perfect opportunity to re-enter when the conditions align again. I'll be keeping a close eye on it. If you want to follow my real-time trades and get updates as I make moves, join my Discord. You'll get the latest market insights and trade alerts as soon as they happen. Let's make sure we don't miss the next big move. As always, stay smart, manage your risk, and don't get caught up in the fear of missing out. This market can move fast, and understanding these underlying dynamics could give you the edge you need. If you found this analysis helpful, don't forget to like the video, subscribe, and hit that notification bell so you don't miss any future updates.
And see you in the next one.